Ajay, we will have to decide whether we want to be cautious at this time or carry on this kind of euphoria, the exuberance, the positivity. Let's find out from our guest. Sunil Subramaniam, Managing Director and CEO of Sundaram Mutual, is with us. And of course, we are looking at Manish Singh joining us, Chief Investment Officer at Crossbridge Capital. Many thanks, gentlemen, for making the time for joining us on the show. Let me come to you first, Manish Singh. Looking at the way the markets are currently poised right now after the correction we've seen in August, do you think we are in overbought territory now in September within the action of the 7 trading sessions that we've seen in September? How are you looking at valuations? And this at a time where global cues are not the strongest. Our bull run on the Nifty is touching life highs. So with a broad-based kind of participation that we are seeing right now among the Nifty constituents, the question really is this time to be optimistic or cautious?
I would say optimistic, because if you see the success of the G20 Summit, and if you take into account just one thing, if you look at IMEC, the India Middle East corridor that is being talked about, you see that the Biden administration has asked the US Congress to increase their contribution to World Bank by, 25 billion, if I'm not wrong. That will clearly get leveraged by, 10x, 20x. So you have a huge amount of money that could be spent on construction project and everything else. You don't have to look too far, but see what the IRA bill has done in the US, the Inflation Reduction Act. The Inflation Reduction Act was nothing but a spending program. And look what it did to US GDP. So if we are really talking about the capital being spent on building this IMEC, that will lead to a huge amount of not just GDP growth, but also earnings for the companies that are going to get involved. And you're talking about really industrial and every sort of companies getting involved. So that's just the short-term thing. But if you look at medium to long-term progress that's happening, one has to be optimistic. Now, I can't advise on 1 week or 1 month trade because I don't take that view. I always take a medium-term view. On that basis, to me, it says that not being optimistic is not going to be very good for your investments.
To be optimistic, Manish says. Sunil Subramaniam, do you agree? Because we are seeing these equity inflows into SIPs. They continue to be strong, and this bull run that we are now witnessing, it is fueled by domestic participation rather than foreign investors. Some are, in fact, pointing to the success India has had in space exploration currently, the G20 Summit, that these are helping this positive sentiment along. When it comes to domestic investors, would you agree with Manish's point of view? And do you believe then that this rally has legs to sustain, or would you suggest caution?
Well, it depends on 2 things, right? Your time frame of investments, right? What's your time frame, and your risk appetite for volatility. The reason I say that is that if you're looking at the valuations and you're looking at trailing Ps or you're looking at 1-year forward Ps, the market is looking richly valued. But you got to look at the breakup of the buyers. Who are the buyers in the market? It's mutual funds who are largely being fueled by SIP flows and which are largely in the small and mid cap space. If you put those factors together with the fact that liquidity in small and mid caps is much lower than in large caps, even a small amount of liquidity moving in tends to take their prices much higher. Second thing is that fund managers, because they're getting this money through SIPs and by nature of their very construct, look at a 3 to 5 year outlook when they buy a stock or invest in a sector. So they are not looking at the 1 year forward, but each stock they are looking at what is the potential for FY26, FY27 kind of earnings from this, because that's when he expects to reap the rewards. So I think the moment you put on a lens of a 3 to 5 year outlook, these valuations don't look very rich. But bear in mind that if you're an investor with a 1 year to 18-month outlook, then you are definitely going to see a volatile period. Because from an FII perspective, right now, there is no alternative to India because we are a shining light in a world of darkening gloom. But the fact that its oil prices have touched 90 and we are heading into a winter season when oil demand energy is likely to peak. Because India imports 83% of its oil, there's a certain amount of FIIs who would look at a short term and say, is the Indian inflation numbers as well as the fiscal and trade deficit going to get impacted by rising oil? The second aspect to remember is that the December is the month that hedge fund managers book profits. So typically there is some amount of profit booking. So some selling and churning of the portfolio takes place around December, right? So from a foreign perspective, one has to be cautious on the quantum of FII flows that come in. And if there is some FII selling, then mutual fund managers are likely to sell some of their mid and small cap holdings to buy those large caps which have now come down to reasonable levels. So that will lead to some amount of churn and volatility in the mid and small cap. So even a 12 to 18 month time frame, be prepared for volatility. However, if you're either one of two investors, one, you have an outlook beyond 3 to 5 years, then this intermittent volatility should not bother you. You can remain invested. If you're wanting to have some needs in the next 12 to 18 months, then today is a good time to book profits as any. At the same time, if you are a systematic investor, then the ensuing volatility in all the three cap curves is going to represent a wonderful opportunity to buy when the NAVs are low. So, and finally, apart from buying individual stocks, I would recommend that you all invest in multi-cap, flexi-cap, those kind of mutual funds, which carry a diversification of stocks across sectors and across the cap curve. But more importantly, they also have the ability to change allocations between large, mid, and small as the earnings season plays out, right? I finally like to end by saying that at this current moment, right, if you look, the festival season is on. There is expected to be a boom in consumption demand at this time. And I think the earnings season so far has not disappointed. The second is that we are running into an election year, and hence normally consumption picks up because there's a lot of liquidity flowing around during an election year. So that amount of liquidity will give some kind of buying support to stocks. So while there is going to be volatility, I do not expect the falls to be very great. I think there will be support from the SIP book plus the consumption oriented thing to the bottom of the market. But market rising very high will probably, to me, depend on a stability in the price of oil being clearly visible, which may be through after 2-3 months. Right. So that's my recommendation.
So 12 to 18 months, you are expecting volatility. If you have a risk appetite and can withstand that volatility, then Sunil Subramaniam is suggesting that you stay invested, and there are gains to make in these markets because valuations are not as rich as some are pointing out. That's one perspective. But Manish Singh, several factors being put out by Sunil Subramaniam. Among them, what do you make of this sharp run in the broader markets? Is it time to do some reallocation within a portfolio in light of this sharp uptrend we've seen in the mid caps and the small caps? Should one book profits and re-enter later? Where do you see the rewards to risks at this point in time? If they're not the strongest right now, where exactly do you think it's going to play out the most in the times to come if we are to stay invested and go ahead with that optimism you spoke about?
So I would say that that's a very personal question based on investment style. I don't believe that timing is anybody's strength. It's more a matter of luck. However, if your portfolio has become lopsided, I mean, if you have become, your one or two position has become too big to your liking, then you can always chop and change that. Personally, I just do not believe in timing the market. I believe that time in the market is more important than timing the market, because what if you get it wrong, then you might just live to regret it. So I personally don't use that trading style. But having said that, there are certain rules you have to have on your portfolio. What should be your maximum size? How many positions should you have? And if, as has been mentioned, if a stock is particularly volatile, then what should be your exposure to that? Those parameters, of course, has to be taken into account, and you can make some changes for that. But as for the question about should you sell and then come back in the market at a lower price, if one is good at that, and if one has evidence that one is good at that, then one should do it. I personally find it a very difficult decision to make. So I take a more medium-term approach to investing. And on that basis, I would not recommend chopping and changing too much.
Jig of a portfolio, Sunil Subramaniam, want to take in your view as well. And this about the broader markets because, it has been a sharp uptrend that we are seeing over there. And that's where, because you're talking about volatility in the next 12 to 18 months, would be an important bit to watch out for. Also, these financial stocks, because PSU Banking Index, the Bank Nifty, they figured in the top performing packs on the Nifty. Inflation pressures, you mentioned those. Those are still holding up. The Fed's decision is on the anvil. Though, of course, there is a little bit of volatility as far as visibility is concerned. Crude oil prices as well, they have been on the rise, but you can see where it could stabilize. We've had a deficient monsoon as well. So there are these moving pieces. So how do you see the financial pack performing besides what we are seeing in the broader markets?
So on the financials pack, typically the story is that a rising interest rate scenario doesn't work well for financials is the textbook theory. But I think in India, we are going through a very unusual phase where banks and financial institutions in the COVID phase, when there was ample liquidity and interest was very low, did lock on to long-term sources of funds from the public as well as from overseas, right, through masala bonds. So I think that today, if you see credit demand is rising faster than deposit accretion, right? Second aspect is RBI, all of RBI's rate hikes, almost double of the rate hikes have been passed on in the loan sector as opposed to the deposits. So banks are clearly being able to use the demand supply equation because not only have you had consumer discretionary demand like housing and auto, which are fueled by EMIs going up, but high-end premium cars, like cars above 7 lakhs, are the ones more in demand. Premium houses are the one more in demand. So the banks have been able to easily pass on the rate hikes. So in today's situation, with a capex cycle along the way, and small and medium corporates needing bank fundings to, both increase their capacities as well as, buy the raw materials to fill the order books which are coming in, right? I don't see that interest rates are going to be something that prevents the small and medium from borrowing. So banks should be able to pass on any rate hikes that the RBI is forced to do, either because the Fed is hiking or because local inflation is rising, to the borrowing public. So I am not too worried about the negative impact, which is normally the case in a rising interest rate. I think Indian banks are poised, and especially the PSU pack, because they are more into corporate lending, they are more into deep Bharat, as they say, right? Their network will help them to pass on these rate increases to the borrowing public. So I'm not. I'm of the view that banking stocks will post increasing earnings potential. But that being bared in mind, this factor has been factored in by the markets. Yes. So I think banks will give a stable return. There won't be any much surprises, either negative or positive. Sure. But it's a good, safe place to lay your bets on. So financial services is one of our top picks in terms of our portfolios.
Fair enough. Manish, what about the sectors you're favoring? Metals and auto stocks, they've led the current rally on the Nifty. You think they are going to continue being star performers?
Well, I mean, as I said, I don't do the sector as such. I mean, for me, it's more of a broader index level view that I like to hold when I'm investing.
But also when you look at, Manish, when you look at the earnings trajectory that we've had right now, because there is so much of this gusto about India's economic prowess, capex is something that we are seeing on an upcycle as well. Do you think that is going to fuel the kind of rally we are currently seeing in the markets?
I agree 100% on that. I mean, that those are the key, what you call, infra heavy sectors. We're talking about industrials, chemicals, and other things, which are going to continue, and that should not change. And just to pick up on something you mentioned about financials as well. I mean, these are the key sectors, that makes an economy. And I would think that in all these sectors, the key sectors are going to do well. And in fact, the bullishness that you're seeing in the market, and you do rightly mention that a lot of these things is domestic money going into capital market. I think those are not just sign of strength, but you're seeing the same thing abroad as well. If you see the news coverage, and I can tell you from being here in London, in how the news is being covered about G20 and the videos and clips, the sentiment is extremely positive. And that has been a massive change compared to what you saw in the past. And there's always an extra premium for these things because most of the time it's the sentiment that drives capital. And when that capital is driven and goes and will be put to good use, then that's when you get GDP growth. So my views, as you know from my previous conversations with yourself, Vikram, is that I think that those things are going to continue, and you're going to have some ups and downs because, if Fed was to raise, I don't believe Fed is going to raise rates anymore, by the way. But if anything else was to happen and oil price was to go much higher, then that would have an impact, but that would just be an opportunity to go and buy some more. And finally, if you look at seasonality, and this does apply more in the US, but there's no reason why Indian market should not also be impacted by that. Seasonally, we are entering into a bullish phase. If you look at when the markets have performed really well, it's always from October to December, 3 months. So seasonally, we are entering a bullish phase. We've had a sideways movement from almost July, August, and we are in September now. So as per me, as I have mentioned before, I think it's all the signs that you should stay invested and look for positive returns.
Well, there is the festive season as well. And so as far as seasonality is concerned, there are the entire up moves being fueled by consumption. And the domestic consumption story is what India has propelled itself on. But Sunil, talking about G20, like Manish brought up as well, the stocks related to sugar and ethanol, they rallied on that announcement of the G20 biofuel initiative. And on the whole, we've seen power stocks come into focus because of the demand-supply mismatch, the government hoping to boost energy production through renewables, the number of thermal power plants, etc. So are the fundamentals of power companies, especially power generation, looking strong for further upsides?
The fundamentals are looking decent, but I think what's led to the rally is all the fact that in a world in a slowdown, there was a feeling that energy prices would head down, and hence power stocks had got hammered related to other sectors. So there is a huge valuation uptick, and so money is flowing into those as a catch-up rally at this point in time. The demand supply situation on power is definitely favorable from that. But like I said, if you see the energy sector, oil price rising, so the energy companies, right? So you got to look at from what the government actions will be in an election year. They will probably tend to hike the windfall gains tax on these companies and keep the prices for the consumer low in an election year. So I would say that the catch-up rally has happened, but I would still be cautious in terms of the power sector, because if new capacity has been created, you might have a short-term excess supply situation. So I would wait and watch and be very stock-specific in the power and energy sector.
Great to have your perspective on what's going on in the markets. We are seeing these upsides and whether they'll sustain or not. For the most part, we're getting one unified voice which says the optimism is something that you can bet on and you can invest further, provided you have the risk appetite, because like Sunil Subramaniam pointed out, that we can expect volatility, we can expect some amounts of correction of the next 12 to 18 months. Manish Singh, Sunil Subramaniam, thank you very much for joining us on this edition of India Tonight with your thoughts.
Thank you.
Meanwhile, celebrations like